Welcome to your practice review for the New York Life Accident and Health Insurance exam. Every question mirrors the real exam. We break down why the right answer works, why others fail, and the concept behind it. Today's questions cover life insurance basics and provisions, annuities and retirement accounts, health, disability and long-term care, Medicare, Medicaid and NY programs, licensing and regulation. Our website offers free exam guides and practice questions to help you pass your New York insurance exam with confidence. You'll find clear explanations, sample questions, and helpful study tips all in one place. Just check the link below to get everything you need to study smarter, not harder. Alright, let's jump in. Question 1. A group health plan in which employees pay part of the premium, so that a stated percentage must enroll to discourage adverse selection, is best described as which of the following? Your options are A. A contributory plan, B. A non-contributory plan, C. A blanket plan, D. A reciprocal plan. Which one is it? Pause the video if you need more time. The correct answer is A, a contributory plan. A is correct because a contributory plan has employees share the premium cost, so the insurer requires a minimum percentage to enroll. The participation rule keeps healthier members in the pool and limits adverse selection. B is wrong because a non-contributory plan is fully employer paid with automatic coverage, so it needs no participation requirement and is not employee funded. C is wrong because a blanket plan covers a constantly changing, unnamed group and does not describe an employee plan with shared premiums. D is wrong because a reciprocal plan refers to an insurer ownership structure, not a group health plan in which employees help pay the premium. Let's break down why insurers require a minimum percentage of employees to enroll in group health plans. In a contributory plan, the employer and employees share the premium cost, with workers paying their portion through payroll deductions. Because employees choose whether to enroll, insurers require a stated participation percentage, often around 75%, before the group qualifies for coverage. This participation rule exists because of adverse selection. Employees who expect to need care are the most eager to enroll, while healthy workers often opt out to save money. Left unchecked, this self-selection fills the risk pool with claims and drives premiums out of control. Picture the risk pool itself. Healthy and sick employees combine their premiums into one shared fund. The participation threshold acts like a gate, making sure enough healthy workers join so the pool doesn't skew toward high-cost claims. Contrast this with a non-contributory plan, where the employer covers the entire premium and every eligible employee is automatically enrolled. With no choice involved, there's no adverse selection to guard against, so insurers require full 100% participation instead. Whether employees contribute is the hinge that decides which rule applies. Question 2. A managed care plan that blends HMO and PPO features, using a primary care physician but allowing out-of-network care at higher cost, is best described as which of the following? Your options are A. An exclusive provider organization, B. An indemnity plan, C. A point-of-service plan, D. A staff model HMO. Take a second. Which answer would you pick? The correct answer is C. A point-of-service plan. C is correct because a point-of-service plan combines HMO and PPO traits, routing care through a primary care physician yet letting members go out of network if they accept higher cost sharing. It trades some control for flexibility. A is wrong because an exclusive provider organization pays only for in-network care, lacking the out-of-network option that defines a point-of-service plan. B is wrong because An indemnity plan reimburses any provider with no network structure or gatekeeper, unlike the hybrid point-of-service design. D is wrong because a staff model HMO confines members to physicians. It employs and offers none of the out-of-network flexibility described. A worker in Rochester wants managed care savings but won't give up her out-of-network specialist. The plan built for that exact tension is the point-of-service plan, a hybrid whose whole identity is compromise. Its two parents are pure opposites. An HMO requires a primary care physician gatekeeper and pays nothing outside its network. A PPO skips the gatekeeper and allows out-of-network care at higher cost. One trades freedom for savings, the other trades savings for freedom. The point-of-service plan keeps the HMO's primary care physician as coordinator, but borrows the PPO's escape hatch. At the point each service is needed, the member decides stay in network for low cost, or step outside and pay more through tiered cost sharing. Watch for lookalikes. An exclusive provider organization has no out-of-network benefit. An indemnity plan has no network and no gatekeeper. A staff model HMO restricts members to employed physicians only. None combine a gatekeeper with a paid out-of-network option like point-of-service does. The test that matters: can the member go outside network and still get paid? Yes, but at a price that's point-of-service. Question 3. A disability income policy that pays full benefits when the insured cannot perform the duties of their own regular job uses which definition of total disability? Your options are A. The own occupation definition, B. The any occupation definition, C. The presumptive definition, D. The residual definition. Before I reveal it, which one do you think is right? The correct answer is A. The own occupation definition. A is correct because the own occupation definition treats the insured as totally disabled when they cannot perform their own job, even if they could do other work. It is the more generous and more expensive standard. B is wrong because the any occupation definition is stricter, paying only when the insured cannot work at any suitable job, so it does not match this description. C is wrong because the presumptive definition automatically deems certain severe losses total disability and is not the general test based on one's own job. D is wrong because the residual definition pays a partial benefit for lost income after returning to work, not a full benefit based on the own occupation. Disability insurance policies define total disability in very different ways, and the definition a policy uses determines whether a claim actually gets paid. Picture a surgeon whose hand develops a tremor. She can no longer operate, but she can still teach, consult, and testify as an expert witness. Under an own occupation definition, losing the ability to do her own specific job is enough to qualify as totally disabled. 4 standards decide when benefits trigger. Own occupation pays when you can't do your own job. Any occupation only pays when you can't do any suitable job. Presumptive disability automatically qualifies catastrophic losses like blindness or lost limbs. Residual disability pays a partial benefit when you return to work at reduced capacity. Own occupation and any occupation sit at opposite ends of the same spectrum, both measuring how strictly a policy defines disability. One asks only about your specific job, while the other asks about every job you could reasonably hold. The part to remember is simple. Whether a policy asks about your own job or any job tells you the whole story of when it pays. Question 4. A life insurance policy is arranged for the benefit of an investor who has no relationship to the insured and no interest in their survival. New York prohibits this as which of the following? Your options are A. A viatical settlement, B. A key person policy, C. A third-party assignment, D. Stranger-originated life insurance. What's your answer? Commit to one before I continue. The correct answer is D, stranger-originated life insurance. D is correct because stranger-originated life insurance is initiated for investors lacking insurable interest in the insured. New York bans it because valid coverage requires insurable interest at the policy's origination. A is wrong because a viatical settlement is the lawful later sale of a policy by a terminally ill owner who did have insurable interest when the policy began. B is wrong because a key person policy rests on the genuine economic interest a business has in an employee, exactly the insurable interest that the scheme lacks. C is wrong because a third-party assignment transfers an existing valid policy and is permitted. The prohibition targets policies originated for investors from the start. Insurable interest is the doctrine that decides who is even allowed to own a life insurance policy on someone else's life. Without a genuine stake in someone's survival, a life insurance policy becomes little more than a wager on when they will die, and it can even create a financial incentive to hasten that death. That is why the law demands real interest, whether love, family, or money owed. So insurance protects instead of speculates. Picture an investor with no family tie, no business stake, and no loan owed to a man in Syracuse, arranging a policy on his life and collecting when he dies. This stranger-originated scheme has no relationship linking the investor to the insured's survival, only a payout tied to his death. The rule that matters is timing. Insurable interest must exist when a policy begins, not forever after. That is why a viatical settlement, a key person policy, and a third-party assignment are all lawful, each built on interest present at inception, even if the policy changes hands later. So don't ask whether a policy was sold later. Ask only one question: was there insurable interest the moment the policy was born? Question 5. If an insured's age was understated on the application and the error surfaces at death, how does New York require the insurer to handle the death benefit? Your options are: A. Adjust the benefit for the true age. B. Deny the claim entirely. C. Pay the full face amount. D. Refund only the premiums paid. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Adjust the benefit for the true age. A is correct because with a misstatement of age, the insurer does not void the policy. It adjusts the death benefit to what the premiums actually paid would have purchased at the insured's correct age. B is wrong because denying the claim overreaches. Age misstatement is corrected by adjusting the benefit, not by treating the policy as if it never existed. C is wrong because paying the full face amount ignores the correction the law allows, since the premiums were set for a younger, cheaper age. D is wrong because refunding premiums is not the remedy. The policy stays in force with the benefit recalculated for the insured's real age. When an insured's age was misstated, the law doesn't void the policy, it fixes the math. Here's how the misstatement of age provision keeps things fair. Premiums are priced entirely on age. An older applicant is statistically closer to death, so insurers charge more per dollar of coverage. When age is understated, the insured has been paying a younger, cheaper rate, funding less coverage than the face amount suggests. Picture the insurer recalculating the stated age of 48, the true age of 52, and the premium he actually paid all combined to produce a smaller, recalculated death benefit. It's tempting to deny the claim, pay the full face value, or simply refund premiums, but none of those match the law. Denying overreaches, paying full face ignores the underpriced premium, and refunding premiums abandons the contract entirely. Only adjusting the benefit gets it right. The premium and the benefit are two sides of one equation. When age was wrong, it's the benefit that gets corrected, not the policy's existence. Fairness, not forfeiture, is the governing idea. Question 6. Because their values depend on investment performance. Variable life and variable annuity products are regulated not only by New York but also by which additional authorities? Your options are A. State banking regulators only, B. County licensing boards, C. Federal securities regulators, D. The Federal Reserve System. Which would you go with? Lock it in before the reveal. The correct answer is C. Federal securities regulators. C is correct because variable products are treated as securities, so federal securities regulators oversee them alongside New York. A producer must hold both a securities registration and an insurance license to sell them. A is wrong because banking regulators supervise depository institutions such as banks, not the investment-based insurance products that are treated as securities and fall under federal securities oversight. B is wrong because county licensing boards play no role in insurance or securities regulation, which are handled at the state and federal levels. D is wrong because the Federal Reserve sets monetary policy and supervises banks. It does not regulate the sale of variable insurance products as securities. Variable life and annuity products sit in an unusual legal space because their value isn't guaranteed by the insurer. It rises and falls with the investments the owner chooses. New York's Department of Financial Services guards insurer solvency and contract fairness, while federal securities law protects investors through mandatory risk disclosure. Because a variable product is both an insurance contract and an investment, it triggers both regimes simultaneously. A variable contracts fund sit in a separate account, invested in sub-accounts that behave like mutual funds, rather than the insurer's general account. Since the insurer makes no promise about the outcome, any loss in the sub-accounts becomes the owner's loss, and that transfer of risk is exactly what defines a security. That risk transfer creates a direct consequence for the producer. Legally offering a variable annuity requires an insurance license, a passed securities exam, and an active association with a broker-dealer. Miss any piece, and the sale isn't legal. A fixed product guarantees principal through the insurer's general account, so only state insurance law applies. A variable product guarantees nothing, and risk borne by the owner is exactly what doubles the regulators. Question 7. Under the Federal Affordable Care Act, a plan that offers dependent child coverage must let an adult child stay on a parent's plan until reaching which age? Your options are A. Age 21, B. Age 25, C. Age 30, D. Age 26. Don't overthink it. Which one feels right? The correct answer is D. Age 26. D is correct because the Affordable Care Act lets young adults remain on a parent's plan until age 26, regardless of student or marital status. This extended dependent coverage is one of the law's core protections. A is wrong because age 21 was a common cutoff before the Affordable Care Act and is earlier than the age the law now guarantees. B is wrong because age 25 falls short of the federal standard. The law extends dependent eligibility 1 year beyond that point. C is wrong because age 30 exceeds the federal requirement. The Affordable Care Act sets the dependent coverage age lower than that. The Affordable Care Act guarantees adult children can stay on a parent's health plan until they turn 26. Before this law, plans often dropped dependents at 19, or a few years later if they left school. Graduates and young workers without job-based insurance simply fell through the cracks. The rule's strength lies in what it ignores. Eligibility doesn't depend on student status, marital status, financial dependency, or where the adult child lives. Only age matters. The mechanism runs through the parent's own plan. If it covers dependent children at all, It must extend that coverage up to the cutoff of 26. Test riders love near-miss ages. 21 was the old cutoff. 25 is 1 year short. And 30 overshoots the mark entirely. Only 26 is correct, regardless of student or marital status. Question 8. Under New York's minimum standards, a long-term care policy must be renewable at the insured's option and cannot be cancelled for declining health. This required renewal status is which of the following? Your options are A. Guaranteed renewable, B. Conditionally renewable, C. Optionally renewable, D. Cancelable at will. Got a guess? Lock it in. The correct answer is A. Guaranteed renewable. A is correct because New York requires long-term care policies to be guaranteed renewable, so the insurer must renew at the insured's option and cannot cancel because the insured's health has worsened. B is wrong because a conditionally renewable policy permits non-renewal on stated grounds, which falls short of the guaranteed status New York requires. C is wrong because an optionally renewable policy leaves renewal to the insurer's discretion, the opposite of the protection the state mandates. D is wrong because a cancelable policy could be terminated at any time, which New York does not allow for long-term care coverage. Renewal status decides who controls whether a policy continues each year, and on what grounds. New York requires the strongest version of that protection for long-term care insurance, guaranteed renewable. Under this status, the insurer must renew the policy as long as premiums are paid, and it can never refuse renewal because the insured's health got worse. The only thing the insurer can still change is price, and even then only for an entire class of similar policyholders, not one sick individual. Picture the policy split into two separate controls. The insured holds the renewal right, locked and guaranteed, while the insurer holds only the premium lever, and that lever moves for the whole class at once, never targeting one person's declining health. Weaker statuses fall short of New York's mandate. Conditionally renewable lets the insurer refuse on stated grounds. Optionally renewable puts renewal entirely at the insurer's discretion, and cancelable at will allows termination at any moment, or gaps the state won't tolerate for long-term care. Guaranteed renewable freezes the insurer's power to drop the insured, but it never freezes the price for the whole class. Staying covered is the guarantee. Staying at the same cost never was. Question 9. Under which federal law must a covered employer keep an eligible employee's group health coverage in force during a period of unpaid, job-protected family or medical leave? Your options are A. COBRA, B. ERISA, C. the Family and Medical Leave Act, D. the Affordable Care Act. Which one is it? Pause the video if you need more time. The correct answer is C. The Family and Medical Leave Act. C is correct because the Family and Medical Leave Act requires a covered employer to maintain an eligible employee's group health coverage during job-protected leave, as though the employee was still actively working. A is wrong because COBRA lets a person continue coverage after it would otherwise end, not the duty to maintain coverage during protected leave. B is wrong because ERISA sets general benefit plan standards and does not specifically require continued coverage during family or medical leave. D is wrong because the Affordable Care Act reshaped coverage rules broadly, but is not the law requiring coverage to continue through protected leave. The Family and Medical Leave Act answers one specific question. What happens to your health insurance when you take protected leave for a family or medical reason? During qualifying leave, the employer must keep the same group health plan running on the same terms as if the employee was still working. The employee still pays their usual premium share, but the employer can't treat the leave as a termination of benefits. Picture the group health plan as one continuous structure that never pauses during leave. The employer keeps it running. The employee keeps paying their share, and every term stays exactly the same. The duty only applies when 4 conditions line up: a covered employer above the size threshold, an eligible employee who's worked long enough, a covered reason like childbirth or a serious health condition, and genuinely protected leave. 3 other laws get confused with this one. COBRA continues coverage after employment ends. ERISA sets broad standards for benefit plans, and the ACA reshaped coverage rules widely. But none of them require maintaining coverage during protected leave the way the FMLA does. Question 10. A New York public program that provides low-cost or free health coverage to children whose families earn too much for Medicaid is best described as which of the following? Your options are A. Medicare Part C, B. Healthy New York, C. A Medicare supplement, D. Child Health Plus. Take a second. Which answer would you pick? The correct answer is D. Child Health Plus. D is correct because Child Health Plus offers low-cost or free health coverage to New York children whose family income is above the Medicaid limit, ensuring children can still get comprehensive coverage. A is wrong because Medicare Part C is the private Medicare Advantage option for Medicare beneficiaries, not a children's health coverage program. B is wrong because Healthy New York helps small employers and their workers afford coverage, and is not the children's program the question describes. C is wrong because a Medicare supplement fills Medicare's gaps for older or disabled adults and has nothing to do with covering children. Child Health Plus exists to solve one specific problem, a gap between 2 safety nets in New York's health coverage system. Medicaid has an income ceiling, so a family earning just above it no longer qualifies. But private premiums can still be out of reach. Without a bridge program, their children fall into a coverage no man's land. The coverage itself is broad, not a thin supplement. Depending on family income, it's free or low cost, but it includes checkups, immunizations, doctor visits, and hospital care. Exam writers love to mix this up with similar sounding programs. Medicare Part C serves older or disabled Medicare beneficiaries. Healthy New York helps small employers cover adult workers. And a Medicare supplement fills gaps in Medicare. None of them touch children's coverage. Whenever a scenario pairs children with income just above the Medicaid threshold, that's the unmistakable signal pointing to Child Health Plus. Question 11. When an insurer issues a limited benefit health policy, New York requires the policy to carry which of the following so the buyer understands its narrow scope? Your options are A. A prominent limited policy notice, B. A securities disclosure, C. A free annual checkup, D. A guaranteed renewal clause. Before I reveal it, which one do you think is right? The correct answer is A. A prominent limited policy notice. A is correct because a limited benefit policy must display a prominent notice telling the buyer the coverage is limited. The warning prevents a purchaser from mistaking narrow benefits for comprehensive protection. B is wrong because a securities disclosure applies to investment products, not to a limited health policy whose required warning concerns its narrow benefits. C is wrong because a free annual checkup is a wellness feature of some plans and is not the disclosure a limited policy must carry. D is wrong because a guaranteed renewal clause concerns continuation of coverage, not the notice warning a buyer that benefits are limited. New York requires limited benefit health policies to carry a prominent, mandatory notice warning buyers that the coverage is narrow. The problem this rule solves is buyer confusion. A policy labeled health coverage can look comprehensive when it actually pays only for cancer, accidents, or a flat hospital fee. Someone might buy a cancer-only plan believing they're fully covered, then face a heart attack with no protection at all. The mechanism is simple: a bold warning placed on the policy's cover or first page, in language too visible to miss, stating that benefits are limited and the policy is not a substitute for comprehensive coverage. This warning is distinct from other disclosures. A securities disclosure covers investment products like variable annuities. A free annual checkup is just a wellness perk. And a guaranteed renewal clause concerns whether coverage continues over time. None of these address a policy's narrow scope. The rule exists so buyers see the limits before they sign, not after a claim is denied. Question 12. A limited policy that pays benefits only if the insured is diagnosed with one named illness, such as cancer, is best described as which of the following? Your options are A hospital indemnity policy, B, a specified disease policy, C, a major medical policy, D, an accident-only policy. What's your answer? Commit to one before I continue. The correct answer is B, a specified disease policy. B is correct because a specified or dread disease policy pays benefits only for one named illness, such as cancer. Its coverage is intentionally narrow, so it supplements rather than replaces broad medical insurance. A is wrong because a hospital indemnity policy pays a fixed amount per day of confinement for any cause, not benefits tied to a single named disease. C is wrong because a major medical policy covers a broad range of illnesses and injuries, the opposite of coverage limited to one disease. D is wrong because an accident-only policy responds to injuries from accidents, not to the diagnosis of a specified illness like cancer. Let's break down what makes a specified disease policy unique and why it's such a favorite subject on exams. This policy pays only when the insured is diagnosed with one named illness, classically cancer, and pays nothing for any other condition. It typically pays a lump sum or scheduled cash benefit regardless of actual medical costs, and it's meant to supplement, never replace, a major medical plan. Picture the policy structured around a single trigger: diagnosis of the named illness. That diagnosis unlocks a cash benefit that can cover non-medical costs like a mortgage, while the whole product exists only as a supplement layered on top of broader health insurance. It helps to compare this to its neighbors. Hospital indemnity pays for any hospital stay regardless of the cause. Major medical covers a broad range of illnesses and injuries. And accident only covers injuries from accidents but never sickness. Whenever a scenario describes a policy paying only for one named illness like cancer, that specified disease coverage, narrow, supplemental, and never a standalone health plan. Question 13. An annuity purchased with a single payment that begins paying income to the owner within about a year of purchase is best described as which of the following? Your options are A flexible premium annuity, B, a deferred annuity, C, an immediate annuity, D, a variable annuity. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C, an immediate annuity. C is correct because an immediate annuity, funded by a single premium, starts income payments soon after purchase with essentially no accumulation period. It is the standard choice for turning a lump sum into income at once. A is wrong because a flexible premium annuity is funded by varying payments over time and is always deferred, since income cannot begin while contributions continue. B is wrong because a deferred annuity delays income to a future date, the opposite of a contract that starts paying within about a year. D is wrong because a variable annuity describes how the value is invested, not when payments begin. It can be either immediate or deferred. Annuities are often explained as one big idea, but they really live on two separate axes: how they're funded and when they start paying out. Keeping those axes apart is the key to understanding the immediate annuity. Funding asks whether the premium is a single lump sum or flexible ongoing payments. Timing asks whether income starts immediately or after a delay. Investment style asks whether the money sits in fixed or variable sub-accounts, and a contract has one answer on each axis. Picture a single premium entering the insurer all at once, with no waiting period, and income payments flowing right back out almost immediately. Because the full amount is present from day one, the contract can start liquidating principal and interest right away instead of spending years building value. An immediate annuity is single premium funded with income starting right away, while a deferred annuity delays that income to the future. A flexible premium annuity adds money over time, so it can never be immediate. Variable simply describes how funds are invested, and it can pair with either immediate or deferred timing. Timing and investment style are independent questions, and an immediate annuity is simply the contract that begins paying without delay, funded by the single premium that makes that immediacy possible. Question 14. A careless or indifferent attitude toward loss because insurance will cover it, such as leaving a door unlocked, is best described as which type of hazard? Your options are A. A moral hazard, B. A physical hazard, C. A speculative hazard, D. A morale hazard. Which would you go with? Lock it in before the reveal. The correct answer is D. A morale hazard. D is correct because a morale hazard is indifference to loss born of knowing that insurance will pay. The insured grows careless as with an unlocked door, raising the likelihood of a claim. Is wrong because a moral hazard springs from dishonesty and the intent to profit from loss, not from mere carelessness produced by having coverage. B is wrong because a physical hazard is a tangible feature of a property or person that increases risk, not an attitude or state of mind. C is wrong because speculative hazard is not a recognized term. Insurance classifies hazards as physical, moral, or morale, so this choice names a category that simply does not exist. Hazards are conditions that increase the chance or size of a loss, and morale hazard is the one rooted in attitude rather than dishonesty or property. Insurers price policies on expected risk, so they classify hazards into three types that quietly push that risk upward. A physical hazard is a tangible feature like oily rags or slippery stairs, while moral and morale hazards live in a person's mindset. The mechanism is psychological. Once people feel protected, some grow less careful, not out of malice but a vague sense that it no longer matters. A homeowner who once double-checked the locks might leave the door unlocked, figuring insurance would cover any theft. The key distinction is intent. Physical hazard is a tangible risk factor. Moral hazard involves dishonesty and a desire to profit from a loss, while morale hazard is pure carelessness with no intent to defraud. Ask whether the behavior involves dishonesty aimed at profit, that's moral hazard, or just laxity born of feeling covered, that's morale hazard. Same sounding terms, opposite states of mind. Question 15. A method of determining how much life insurance to buy by adding up the family's expected expenses and obligations at the insured's death is best described as which approach? Your options are A. The needs approach, B. The human life value approach, C. The cash value approach, D. The income replacement ratio. Don't overthink it. Which one feels right? The correct answer is A, the needs approach. A is correct because the needs approach sizes coverage by totaling the cost a family must meet at death, such as final expenses, debts, and income needs, then subtracting available resources. B is wrong because the human life value approach capitalizes the insured's lost future earning instead of itemizing the family's specific expenses and obligations. C is wrong because cash value describes a savings element inside permanent policies, not a method for calculating how much protection a family requires. D is wrong because an income replacement ratio is a rough rule of thumb tied to salary, not the detailed expense and obligation tally the needs approach uses. The needs approach sizes a life insurance policy by adding up what a family will owe and need after the breadwinner dies, then subtracting what they already have. On the needs side, the family tallies final expenses and debts like the mortgage, an emergency fund, future obligations such as college, and ongoing income replacement for lost earnings. Picture it as simple subtraction, total needs minus total resources like savings, existing insurance, and survivor benefits equals the coverage gap the policy must fill. This contrasts with three other options. The human life value approach instead capitalizes the earner's future income. Cash value is just a savings feature inside permanent policies, not a sizing method, and an income replacement ratio is only a rough multiple of salary. The needs approach asks what the family will owe. The human life value approach asks what the earner's income was worth, recognizing that starting point identifies the method. Question 16. Which settlement option pays the beneficiary a guaranteed income for the rest of their life, with payments ending at the beneficiary's death? Your options are A. Interest only, B. Life income, C. Fixed period, D. Lump sum. Got a guess? Lock it in. The correct answer is B, life income. B is correct because the life income option converts the proceeds into payments guaranteed for the beneficiary's lifetime. The insurer bases the amount on the beneficiary's age and stops payments at death. A is wrong because the interest-only option pays just the earnings and preserves the principal, so it does not provide a guaranteed lifetime income. C is wrong because the fixed period option pays for a set number of years and then stops, regardless of whether the beneficiary is still living. D is wrong because a lump sum delivers the whole amount at once and creates no ongoing income stream tied to the beneficiary's life. Life income is a settlement option that turns policy proceeds into a payment stream guaranteed for as long as the beneficiary lives. The insurer promises income for as long as the beneficiary is alive, no more and no less. Payments stop the moment the beneficiary dies and any unpaid balance is forfeited, not passed to heirs. To make this promise work, the insurer prices payments using the beneficiary's age and life expectancy. Younger beneficiaries get smaller checks spread over more expected years, while older beneficiaries get larger checks over a shorter horizon, with the risk pooled across many lives. Other settlement options end differently. The fixed period option pays for a set number of years and stops on a date, not a death. Interest only pays just the earnings while the principal stays on deposit, and a lump sum pays everything at once with no ongoing stream. Whenever a question describes guaranteed income for life that stops at death, that is the identifying signature of the life income option. Question 17. Which rider periodically increases a policy's death benefit to keep pace with inflation, usually without requiring new evidence of insurability? Your options are A. The return of premium rider, B. The accidental death rider, C. The cost of living rider, D. The pay or benefit rider. Which one is it? Pause the video if you need more time. The correct answer is C, the cost of living rider. C is correct because the cost of living rider raises the death benefit at intervals to offset inflation, typically tied to an index. The increases usually require no new medical evidence to take effect. A is wrong because the return of premium rider refunds premiums if the insured survives a term and does not adjust the benefit for inflation. B is wrong because the accidental death rider pays extra only for an accidental death and provides no inflation-based growth in the benefit. D is wrong because the payor benefit rider waives premiums on a juvenile policy when the payor dies or is disabled, unrelated to inflation protection. Life insurance makes a long-term promise in fixed dollars, but inflation quietly erodes that promise over time. The cost of living rider exists to fight back against that slow decay. Think of inflation like a slow leak in a tire, so gradual you barely notice it until the tire is flat. Over 20 or 30 years, that same erosion can shrink the real value of a death benefit that once looked generous. The rider works by tying automatic increases to a recognized price index, raising the death benefit at set intervals for an added premium. Critically, it does this without requiring a new health exam. Other riders solve different problems. The return of premium rider refunds premiums. The accidental death rider pays extra only for accidental deaths. And the payor benefit rider waives premiums if a juvenile policy's payor dies or becomes disabled. Only the cost of living rider grows the benefit specifically to offset inflation. Remember the pairing. A death benefit that rises over time to keep pace with prices, growing without proof of insurability, always signals the cost of living rider. Question 18. A policy owner names a beneficiary whose written consent is required before the owner may change the designation or take certain policy actions. This beneficiary is which of the following? Your options are A, a revocable beneficiary, B, a contingent beneficiary, C, a primary beneficiary, D, an irrevocable beneficiary. Take a second. Which answer would you pick? The correct answer is D, an irrevocable beneficiary. D is correct because an irrevocable beneficiary holds a vested interest. The owner cannot change the designation, assign the policy, or borrow against it without that beneficiary's written consent. A is wrong because a revocable beneficiary can be replaced freely by the owner, so it grants none of the protected, consent-required status described. B is wrong because a contingent beneficiary only collects if the primary dies first and does not gain a vested right to block owner changes. C is wrong because a primary beneficiary is simply first in line for the proceeds and may still be revocable unless named irrevocable as well. Let's unpack what makes a beneficiary irrevocable and why that one word changes everything about a policy. An irrevocable beneficiary holds a vested, protected interest in the policy. That means the owner cannot change the beneficiary, take a loan against the policy, or assign it away without the beneficiary's written consent. Picture the policy structure. The owner still holds the contract, but the irrevocable beneficiary's consent is required before three specific actions: changing the beneficiary, borrowing against the policy, or assigning it to someone else. Compare this to other beneficiary types. A revocable beneficiary can be swapped out anytime, no permission needed. A contingent beneficiary only collects if the primary beneficiary dies first, and a primary beneficiary is simply first in line, neither carries any consent power. Whenever you see the phrase written consent tied to changing a policy, think irrevocable beneficiary. That's the trait the exam is testing. Question 19. When comparing Medicare, Medicaid, and long-term care insurance, which one is purchased in advance specifically to pay for extended custodial care and avoid spending down assets? Your options are A. Long-term care insurance, B. Medicare Part A, C. A Medicare supplement. D. Medicaid. Before I reveal it, which one do you think is right? The correct answer is A. Long-term care insurance. A is correct because long-term care insurance is bought ahead of need to pay for extended custodial care, letting the insured cover that gap without exhausting savings or relying on means-tested programs. B is wrong because Medicare Part A pays only for limited post-hospital skilled care meant for recovery, not the extended custodial care long-term care insurance covers. C is wrong because a Medicare supplement fills Medicare's cost-sharing gaps such as deductibles and co-insurance, and it does not pay for custodial long-term care. D is wrong because Medicaid does cover custodial care, but only after a person impoverishes themselves, which is exactly the spend-down that buyers hope to avoid. Long-term care insurance fills a specific gap. It pays for extended custodial care that no other program covers, and it must be purchased before you need it. This policy must be bought while the buyer is still healthy, because insurers won't sell it once care is already needed. It exists specifically to pay for custodial care, the daily living assistance that helps someone live, not recover, and it lets policyholders protect their assets instead of spending them down. Custodial care means help with the basic activities of daily living, bathing, dressing, eating, and moving from place to place, the support that keeps someone functioning even though it doesn't cure them. Compare the alternatives. Medicare Part A only covers limited skilled care after a hospital stay. A Medicare supplement fills cost-sharing gaps but skips custodial care entirely, and Medicaid does cover custodial care, but only after you've spent down nearly everything you own. Remember the contrast. Long-term care insurance is the proactive purchase that protects your assets, while Medicaid is the fallback that requires losing them first. Question 20. A New York program created to make health coverage more affordable for small employers and their workers through standardized lower-cost plans is best described as which of the following? Your options are A. Child Health Plus, B. Healthy New York, C. Medicaid, D. Medicare Advantage. What's your answer? Commit to one before I continue. The correct answer is B. Healthy New York. B is correct because Healthy New York makes standardized, lower-cost coverage available to small employers and their workers, partly through a state-funded mechanism that reduces the insurer's costs and the premiums charged. A is wrong because Child Health Plus covers children whose families exceed the Medicaid limit and is not a small employer affordability program. C is wrong because Medicaid is a needs-based program for low-income individuals, not a standardized lower-cost option aimed at small employers. D is wrong because Medicare Advantage is a private Medicare option for beneficiaries and has no role in covering small employer workers. Healthy New York exists to solve one specific affordability problem: small businesses that can't afford the rich plans big companies negotiate. Large employers spread risk across many workers and command better pricing, while a small shop with 5 or 10 employees has little bargaining power, faces steep premiums, and often can't offer coverage at all, leaving workers uninsured. The program's fix combines two levers: a standardized, simplified benefit design and a state-funded subsidy that offsets insurer costs, together pushing premiums below what the ordinary small group market would charge. This target population is the tell that separates Healthy New York from lookalike programs. Child Health Plus covers children above Medicaid limits. Medicaid serves low-income individuals generally, and Medicare Advantage covers Medicare beneficiaries, none of them small employer programs. When a scenario names small employers seeking affordable standardized coverage, the answer is Healthy New York. Question 21. A terminally ill policy owner sells an existing life insurance policy to a third party for an immediate cash sum that is less than the death benefit. This transaction is known as which of the following? Your options are A. An accelerated loan, B. A policy surrender, C. A viatical settlement, D. A reduced paid up option. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. A viatical settlement. C is correct because a viatical settlement is the sale of a policy by a terminally ill owner to a third party for cash now. The buyer keeps paying premiums and collects the death benefit later. A is wrong because an accelerated loan is not the transaction. Selling the policy transfers ownership, whereas a loan would keep the policy with the original owner. B is wrong because a surrender returns the policy to the insurer for its cash value, not a sale to an outside investor for a negotiated cash amount. D is wrong because a reduced paid up option uses existing cash value to buy a smaller, fully paid policy and does not involve selling coverage for cash. A viatical settlement happens when a terminally ill policy owner sells an existing life insurance policy to a third-party investor for a lump sum of cash today, less than the eventual death benefit. Surrendering a policy to the insurer only returns its cash surrender value, which can be modest or even zero on a term policy. A third-party buyer will pay more than that because they expect to collect the full death benefit relatively soon. The mechanism is a full transfer of ownership for consideration. The owner assigns the policy to the buyer, who pays the lump sum, takes over future premiums, and becomes the one named to collect the death benefit when the insured dies. Compare that to the alternatives. A policy loan lets the owner borrow against the policy while keeping it. A surrender returns the policy to the insurer for cash value. And a reduced paid up option uses existing value to buy a smaller policy with no sale at all. Only a viatical settlement moves ownership out to an investor. Whenever ownership of a policy passes to an outside investor for cash during terminal illness, that's a viatical settlement. If the owner or the insurer still holds it, it's something else entirely. Question 22. Which part of Medicare provides optional prescription drug coverage through private plans approved by the government? Your options are Medicare Part A, B. Medicare Part B, C. Medicare Part C, D. Medicare Part D. Which would you go with? Lock it in before the reveal. The correct answer is D. Medicare Part D. D is correct because Medicare Part D offers optional outpatient prescription drug coverage through private plans the government approves. Beneficiaries add it to original Medicare or get it within an Advantage plan. A is wrong because Medicare Part A is hospital insurance and does not provide the outpatient prescription drug coverage that Part D supplies. B is wrong because Medicare Part B covers physician and outpatient services, not the standalone outpatient drug benefit offered under Part D. C is wrong because Medicare Part C bundles coverage as a private plan and is not itself the specific prescription drug program described. Medicare Part D exists to cover something original Medicare never did: prescription drugs picked up at the pharmacy. For decades, original Medicare paid for hospitals and doctors but left most outpatient prescription drugs uncovered. Part D was created to close that gap, offering optional coverage delivered through private insurance plans the government has approved, though waiting to enroll can trigger a late penalty. A beneficiary picks a government-approved private plan, pays a premium, and gets drug coverage shaped by that plan's formulary and cost-sharing rules. This coverage applies to outpatient drugs filled at the pharmacy, not medications given during a hospital stay. The other parts of Medicare cover different territory. Part A handles hospital insurance. Part B covers doctors and outpatient services. Part C, Medicare Advantage, bundles private coverage that may include drugs. And Part D is the dedicated prescription drug benefit. When a question points to optional prescription drug coverage through approved private plans, the answer is Part D. Question 23. Under an individual health policy, the insured's first duty after a covered loss is to give the insurer which of the following within the required time? Your options are A. Notice of the claim, B. Proof of loss, C. A completed autopsy, D. A premium payment. Don't overthink it. Which one feels right? The correct answer is A. Notice of the claim. A is correct because the claim process begins with notice of claim, the insured's prompt notification that a loss has occurred. The insurer then sends claim forms and proof of loss follows after that. B is wrong because proof of loss comes later in the sequence, after the insurer supplies claim forms, not as the insured's very first step. C is wrong because an autopsy may be requested only in limited circumstances and is never the insured's required first action after a loss. D is wrong because a premium payment keeps coverage in force and is unrelated to the notice the insured must give when filing a claim. Before proof of loss can happen, something else must come first. Let's break down the exact order every health insurance claim must follow. A structured order exists so both sides know what to do and when. Without it, claims would arrive in chaos and disputes over who did their part would multiply. The sequence unfolds in 4 steps. First, notice of claim. Then the insurer sends claim forms. Next, the insured submits proof of loss. And only then does payment follow. Notice of claim is simple. Just the insured's name, policy number, date of loss, a brief description, and the deadline for reporting, no detailed documentation yet. The trap exam writer set is confusing proof of loss with the first duty. Always remember, notice comes first, because the insurer can't send forms until it's been notified. Question 204. Which provision lets a terminally ill insured collect part of the policy's death benefit in advance to help with medical or living costs? Your options are A. The waiver of premium rider, B. The accelerated death benefit, C. The reduced paid up option, D. The spendthrift clause. Got a guess? Lock it in. The correct answer is B. The accelerated death benefit. B is correct because the accelerated death benefit advances a portion of the face amount to an insured diagnosed as terminally ill. Whatever is paid early reduces the benefit the beneficiary later receives. A is wrong because the waiver of premium rider only excuses premiums during disability and does not release any of the death benefit early. C is wrong because the reduced paid-up option converts cash value into smaller paid-up coverage and is not a way to access the benefit while living. D is wrong because the spendthrift clause protects installment proceeds from creditors and provides no early payout to a terminally ill insured. Let's look at the theory behind this provision, how a dying insured can access part of their own death benefit while still alive. The core idea is timing. Money that would normally go to a beneficiary after death becomes available early. After a terminal illness diagnosis, the insured receives part of the face amount now, though whatever is paid early reduces what the beneficiary receives later, often with no extra premium. Picture the policy's face amount as a single pot of money. The insurer releases one slice of it early to the insured, and whatever remains flows to the beneficiary at death. 3 other provisions do different jobs. A waiver of premium only excuses premiums during disability, A reduced paid-up option converts cash value into smaller coverage, and a spendthrift clause protects installment payments from creditors. None of them release the death benefit early, like the accelerated death benefit does. Remember, the accelerated death benefit is an advance, not free money. The more the insured draws early, the less the beneficiary inherits later. Question 25. An annuity whose values rise and fall with investment subaccounts, requiring the producer to hold a securities registration to sell it, is which of the following? Your options are A. A fixed annuity, B. An equity indexed annuity, C. A variable annuity, D. An immediate annuity. Which one is it? Pause the video if you need more time. The correct answer is C. A variable annuity. C is correct because A. Variable annuity invests in separate account subaccounts the owner selects, so values fluctuate with the markets. Because the owner bears investment risk, it is a security requiring a securities registration to sell. A is wrong because a fixed annuity guarantees principal and a minimum rate through the general account, so selling it needs no securities registration. B is wrong because an equity indexed annuity is a fixed product with index-linked interest and a guarantee, and it does not require a securities license. D is wrong because an immediate annuity describes payout timing rather than how funds are invested and is not by itself a registered security. A variable annuity's identity comes down to one fact: who bears the investment risk. That single detail decides whether it's a security and who's licensed to sell it. The owner chooses subaccounts resembling mutual funds, seeking growth that a fixed annuity's guaranteed rate can't match. In exchange for that opportunity, the owner accepts full responsibility for market swings. Contributions flow into a separate account, kept apart from the insurer's general account, and get allocated among subaccounts, stock, bond, or a mix. Because the insurer makes no promise about the outcome, the owner directly bears the investment risk. That risk-bearing is what separates a variable annuity, where the owner carries the risk and needs a securities registration, from a fixed or equity indexed annuity, where the insurer guarantees principal under an insurance license alone. An immediate annuity simply describes payout timing, not investment risk. When subaccounts fluctuate and the owner absorbs the risk, that's the mark of a variable annuity and the signal that a securities registration is required. Question 26. A limited health policy that pays benefits only for losses resulting from accidents and provides nothing for sickness is best described as which of the following? Your options are A. A major medical policy, B. A comprehensive policy, C. A disability income policy, D. An accident-only policy. Take a second. Which answer would you pick? The correct answer is D. An accident-only policy. D is correct because an accident-only policy pays solely for losses caused by accidents, with no coverage for illness. Its narrow scope makes it a limited policy that must disclose what it leaves out. A is wrong because a major medical policy provides broad coverage for both accident and sickness, far wider than accident-only protection. B is wrong because a comprehensive policy is designed to cover a wide range of medical needs, the opposite of a single peril accident-only plan. C is wrong because a disability income policy replaces lost wages from accident or sickness and is not limited to accident-caused medical losses. An accident-only policy draws one sharp boundary. It pays for losses caused by accidents and pays nothing for sickness. That single line is the entire structure of the coverage. This narrow product exists for affordability. Because accidents are sudden and external, insurers can price the risk cheaply. appealing to people in physically demanding jobs or active lifestyles who want injury protection without paying for broad sickness coverage. Like any limited policy, it must plainly disclose what it leaves out. The mechanism is a trigger tied to accidental cause. A broken arm from a fall is covered, but that same arm weakened by disease is not, because illness develops internally and falls outside the trigger entirely. Compare this to broader products. Major medical covers both accident and sickness. Comprehensive plans cover a wide range of medical needs, and disability income replaces lost wages from either cause. Only accident only draws the hard line at accidental causation. Whenever a scenario describes coverage limited strictly to accidental losses with sickness excluded, that's the signal for an accident-only policy. Cause, not consequence, governs whether it pays. Question 27. Which type of organization provides life insurance to its members through a lodge or social structure and operates on a not-for-profit basis? Your options are a fraternal benefit society, B, a stock insurer, C, a reciprocal exchange, D, a risk retention group. Before I reveal it, which one do you think is right? The correct answer is A, a fraternal benefit society. A is correct because a fraternal benefit society offers insurance only to members of its lodge or society, ties coverage to a charitable or social purpose, and operates without a profit motive. B is wrong because a stock insurer is a profit-seeking company owned by shareholders and open to the general public, not a membership lodge organization. C is wrong because a reciprocal exchange is a pooling arrangement among subscribers managed by an attorney-in-fact, lacking the fraternal lodge and social mission. D is wrong because a risk retention group is formed by businesses with similar liability exposures to insure themselves, a commercial purpose unlike a fraternal society. A fraternal benefit society is a distinctive kind of insurer built on community rather than shareholders. Its identity rests on three linked features working together. First, coverage is tied to membership in a lodge or society. Second, that coverage carries a social or charitable mission. Third, the whole organization operates without a profit motive. The mechanism traces back to mutual aid traditions. Members pool small contributions so the lodge can cover a family when a member dies. That same lodge also runs charitable works, community programs, and social events, since insurance and mission are woven together, with any surplus serving members rather than owners. Contrast this with other structures. A stock insurer is a profit-seeking company owned by shareholders and open to the public. A reciprocal exchange pools subscribers under an attorney-in-fact, and a risk retention group lets businesses insure their own shared liabilities. Whenever a scenario names lodge or society membership paired with a not-for-profit social purpose, you're looking at a fraternal benefit society. Question 28. Long-term care insurance is designed mainly to pay for which kind of assistance that ordinary medical insurance and Medicare largely do not cover? Your options are A, emergency surgery, B, extended custodial and personal care, C, prescription medications, D, short hospital stays. What's your answer? Commit to one before I continue. The correct answer is B, extended custodial and personal care. B is correct because long-term care insurance pays chiefly for extended custodial and personal care, such as help with daily activities, which standard medical insurance and Medicare generally do not cover. A is wrong because emergency surgery is acute medical care paid by ordinary health insurance, not the custodial assistance long-term care addresses. C is wrong because prescription medications are handled by health and drug coverage, not the central purpose of a long-term care policy. D is wrong because short hospital stays are acute care covered by medical insurance, unlike the prolonged custodial care long-term care provides. Long-term care insurance exists to fill one specific gap, the ongoing custodial care that regular medical insurance and Medicare skip. Understanding this gap is the key to the whole concept. As people age or become disabled, they often need help with basic daily activities, bathing, dressing, eating, and moving around. This isn't acute illness, it's the ongoing assistance called custodial care. Picture a woman with advancing dementia who needs supervision and help with these daily tasks for years. Her long-term care policy pays for exactly this kind of assistance, while her medical insurance and Medicare would not. Emergency surgery, prescription drugs, and short hospital stays are all acute care, handled by ordinary medical insurance. Only custodial care, the long day-to-day kind of help, falls to long-term care insurance. Remember, acute care cures, custodial care assist, and long-term care insurance was built precisely for that assisting role. Question 29. A jointly administered trust established by a labor union and participating employers to provide health benefits to union members is recognized in New York as which of the following? Your options are A. A blanket group, B. A reciprocal group, C. An eligible group, D. A debtor group. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. An eligible group. C is correct because New York recognizes a jointly administered union and employer trust, often called a Taft-Hartley trust, as an eligible group that may be issued group health coverage for its members. Is wrong because a blanket group covers an unnamed, shifting class of people and does not describe a defined union-employer benefit trust. B is wrong because a reciprocal group refers to an insurer ownership arrangement, not a recognized category of group eligible for health coverage. D is wrong because a debtor group consists of a lender's borrowers for credit coverage and is not the union trust described in the question. Not every group of people can buy group health insurance. States define which groups are eligible, and one classic example is the Taft-Hartley Trust. Eligibility rules exist to keep group insurance honest, since group pricing assumes a real purpose, brings people together, creating a natural mix of healthy and unhealthy members. A qualifying group must have a real purpose beyond insurance, produce a natural mix of healthy and unhealthy members, be a jointly governed structure, and not simply be a pool assembled to grab coverage. Under federal labor law, a Taft-Hartley trust is jointly administered by representatives of the labor union and the participating employers, existing solely to deliver health benefits to covered workers. Compare this to other labels that sound similar but don't fit. A blanket group covers a shifting, unnamed class like event attendees. A reciprocal describes an insurer ownership arrangement, and a debtor group is simply a lender's borrowers. None of these are the union employer benefit trust. Eligible group status comes from legitimacy and structure, not size. A jointly administered union employer trust formed to provide benefits earns it every time. Question 30. In New York, a licensee who represents the insurance company and is appointed to solicit and sell its policies is acting in which capacity? Your options are A. As a broker, B. As an adjuster, C. As a consultant, D. As an agent. Which would you go with? Lock it in before the reveal. The correct answer is D. As an agent. D is correct because an agent represents the insurer under an agency appointment and acts on the company's behalf when soliciting and selling its policies. The agent's loyalty runs to the insurer. A is wrong because a broker represents the client rather than any single insurer. shopping the market on the applicant's behalf instead of one company's products. B is wrong because an adjuster investigates and settles claims after a loss and is not the licensee who solicits and sells policies for the insurer. C is wrong because a consultant advises clients on insurance matters for a fee and does not act as the insurer's appointed seller of coverage. Every insurance role at its core comes down to one question: whom does this person represent? In New York, an agent is a licensee appointed by an insurance company to solicit and sell its policies. Because the agent speaks for the company, the insurer is bound by what the agent does and is generally charged with knowledge the agent gains in that role. Compare that to the other license roles tested on exams. An agent represents the insurer, a broker represents the applicant and shops the market on their behalf. An adjuster investigates and settles claims after a loss, and a consultant advises clients on insurance matters for a fee. The mechanism behind all of this is the agency appointment. The insurer appoints the agent, granting authority to solicit applications and sell policies, and whatever the agent does within that authority binds the company that appointed them. Whenever a scenario says a licensee represents the insurance company and was appointed to solicit and sell its policies, that role is the agent. Question 31. The traditional government fee-for-service Medicare program, made up of hospital insurance and medical insurance together, is commonly referred to as which of the following? Your options are A. Original Medicare, B. Medicare Advantage, C. A Medicare Supplement, D. Medicaid. Don't overthink it. Which one feels right? The correct answer is A. Original Medicare. A is correct because Original Medicare is the traditional government program combining Part A, hospital insurance, and Part B, medical insurance, letting beneficiaries use any provider that accepts Medicare on a fee-for-service basis. B is wrong because Medicare Advantage is the private plan alternative to Original Medicare, not the traditional government fee-for-service program itself. C is wrong because a Medicare supplement is private coverage that fills gaps in Original Medicare and is not the underlying government program. D is wrong because Medicaid is a separate needs-based program for low-income individuals and is not the hospital and medical Medicare combination the question describes. Let's build the foundation. Original Medicare, the traditional core that every other Medicare option is measured against. Original Medicare combines Part A hospital insurance and Part B medical insurance into one fee-for-service program. Beneficiaries can see any doctor or hospital that accepts Medicare with no network restrictions. Part A covers inpatient hospital stays and skilled nursing care, while Part B covers physician visits and outpatient services. Together they form Original Medicare with the government paying providers directly. It's important to distinguish Original Medicare from its relatives. Medicare Advantage is the private plan alternative. A Medigap supplement is private coverage that fills gaps, and Medicaid is an entirely separate needs-based program. When a scenario describes the traditional government program combining hospital and medical insurance with fee-for-service payment, that's Original Medicare, the baseline for everything else. Question 32. An annuity that credits interest linked to a market index while guaranteeing a minimum and keeping the owner's money in the general account is best described as which of the following? Your options are a variable annuity, B, a fixed indexed annuity, C, a pure life annuity, D, a period certain annuity. Got a guess? Lock it in. The correct answer is B, a fixed indexed annuity. B is correct because a fixed indexed annuity links interest to an index such as a broad stock measure, but keeps the money in the general account with a guaranteed minimum. It is a fixed product, not a security. A is wrong because a variable annuity puts money directly into market sub-accounts with no minimum guarantee, exposing the owner to losses the index product avoids. C is wrong because a pure life annuity is a payout option describing how income is paid, not a way of crediting interest during accumulation. D is wrong because a period certain annuity describes a payout lasting a set number of years and says nothing about index-linked interest crediting. A fixed indexed annuity is a hybrid product that borrows a market-linked feature while staying fully fixed. Understanding how that works is the key to classifying it correctly. 4 features define it: interest crediting tied to a market index, a guaranteed minimum return, principal held in the insurer's general account, and caps or participation rates that limit how much index gain gets passed through. Because the money never leaves the general account, the insurer, not the owner, bears the investment risk, while the index simply determines how much extra interest gets credited. Compare that to the alternatives. A variable annuity places money directly in market sub-accounts with no minimum guarantee, while a pure life annuity and a period certain annuity are payout options describing how income is distributed, not how interest is credited. Remember the signal: index-linked interest, a guaranteed minimum, and general account placement together mean fixed indexed annuity. The insurer bears the risk, not the owner. Question 33. Contributions to a traditional individual retirement account may be tax deductible and the account grows tax deferred. How are qualified distributions later treated? Your options are: A. They are received entirely tax-free. B. They are taxed as capital gains. C. They are taxed as ordinary income. D. They are exempt after age 60. Which one is it? Pause the video if you need more time. The correct answer is C. They are taxed as ordinary income. C is correct because traditional IRA contributions may be deducted and the account grows untaxed, the distributions are taxed as ordinary income when taken. The tax is simply deferred until the money comes out. A is wrong because tax-free distributions describe a Roth IRA funded with after-tax dollars, not a traditional account that deducted contributions up front. B is wrong because capital gains rates do not apply to IRA distributions, which are taxed as ordinary income regardless of how the funds grew. D is wrong because distributions are not made exempt by reaching a certain age. Traditional IRA withdrawals remain ordinary income when received. To understand how traditional IRA distributions are taxed, trace the bargain struck when the money first goes in. Contributions may be deductible and the account grows tax deferred, meaning no tax is paid along the way. In exchange, qualified distributions are taxed as ordinary income when withdrawn. The tax is deferred, not forgiven. Picture the account itself. Money enters with a deduction, grows untouched by tax, and only becomes taxable the moment it comes out. Because none of it was taxed before, the entire withdrawal is taxed now, at ordinary income rates, the same rates applied to wages. Contrast this with a Roth IRA funded with after-tax dollars, which pays out tax-free. A traditional IRA never gets capital gains treatment or age-based exemptions. It's always ordinary income, no matter how the money grew inside. Whenever a scenario mentions deductible contributions and tax-deferred growth, remember the deferral always ends with the tax being paid, in full, as ordinary income. Question 34. The phase of a deferred annuity during which the owner pays in money and the contract grows on a tax-deferred basis is known as which of the following? Your options are: A. The annuity period. B. The payout period. C. The liquidation period. D, the accumulation period. Take a second. Which answer would you pick? The correct answer is D, the accumulation period. D is correct because during the accumulation period, the owner funds the contract and the value builds tax deferred. No income is paid out yet. The money is being assembled for later conversion into payments. A is wrong because the annuity period is when income payments are made to the annuitant, the stage that follows accumulation rather than the pay-in phase. B is wrong because the payout period is simply another name for the annuity period and again describes distributing income, not building the value. C is wrong because liquidation period is not the standard term. The funding stage of a deferred annuity is called the accumulation period. The clearest way to lock in the accumulation period is to see it as the front half of a deferred annuity's life, the building phase that comes before any income is paid out. During accumulation, the owner pays premiums into the contract, whether as a single payment or ongoing contributions, and the value compounds on a tax-deferred basis. No annuity income comes out during this time. The money is simply being gathered and grown. This phase ends only when the owner decides to convert that accumulated value into income. Picture the contract itself. Premiums flowing in, earnings compounding tax-deferred inside it, and nothing flowing out until the owner chooses to convert that value into income. The other answer choices name or mimic the payout side, not the building side. The annuity period and the payout period both describe distributing income after accumulation ends, while liquidation period isn't a standard industry term at all for the funding stage. Whenever a scenario describes money going in and the contract growing tax-deferred with no income paid yet, that's the accumulation period, the building phase before a deferred annuity starts paying out. Question 35. A dividend option that uses each dividend to buy a small amount of additional, fully paid-up permanent coverage is known as which of the following? Your options are A. Paid-up additions, B. Accumulation at interest, C. Cash payment, D. One-year term option. Before I reveal it, which one do you think is right? The correct answer is A. Paid-up additions. A is correct because the paid-up additions option spends each dividend on a small piece of paid-up permanent insurance. These additions raise both the death benefit and the cash value with no extra premium required. B is wrong because accumulation at interest leaves dividends on deposit to earn interest and does not purchase any additional insurance coverage. C is wrong because the cash payment option simply sends the dividend to the owner and adds nothing to the policy's benefit or value. D is wrong because the one-year term option uses each dividend to buy temporary insurance for a single year, not permanent additions that remain fully paid up. Paid-up additions is a dividend option that quietly grows a participating whole life policy from the inside. To understand it, we first need to understand what a dividend actually is. A participating policy may pay dividends when the insurer's experience is favorable. With paid-up additions, each dividend buys a small amount of additional, fully paid-up permanent insurance, so both the death benefit and the cash value increase with no extra premium required. Think of the mechanism as a series of tiny single premium permanent policies. Each dividend acts as a single premium buying a small, paid-up piece of insurance at the insured's attained age, immediately adding to both the death benefit and the cash value, with no medical evidence needed. Compare this to the other dividend options. Accumulation at interest just leaves dividends on deposit earning interest. Cash payment simply sends the dividend to the owner. One-year term uses the dividend to buy temporary insurance for a single year. Only paid-up additions buys permanent, fully paid-up coverage. Whenever a scenario describes a dividend buying small pieces of fully paid up permanent insurance that raise both benefit and value, that pairing of dividends with permanent paid up coverage identifies paid up additions. Question 36. New York allows group health coverage only for groups that exist for a reason other than obtaining insurance. This requirement mainly serves to prevent which of the following? Your options are A. Employer cost savings, B. Adverse selection by unhealthy groups, C. Use of certificates of coverage, D. Coordination of benefits. What's your answer? Commit to one before I continue. The correct answer is B. Adverse selection by unhealthy groups. B is correct because requiring a group to exist for another purpose guards against adverse selection, where a group forms mainly because its members expect heavy claims, which would drive the cost of coverage up. A is wrong because employer cost savings is a normal goal of group coverage, not the harm the eligible group rule is designed to prevent. C is wrong because certificates of coverage are simply how members receive proof of coverage and are unrelated to why a group must exist independently. D is wrong because coordination of benefits manages payment among multiple coverages and is not the concern behind requiring a legitimate pre-existing group. Every legitimate insurance group must exist for a reason beyond buying coverage, and understanding why reveals a core principle of risk pooling. Group insurance stays affordable because a real group, like a workplace, naturally mixes healthy and unhealthy people. If a group formed only to get insurance, mostly sick people would join, concentrating risk and driving premiums sky high. The safeguard is a bona fide, pre-existing purpose, an employer, union, or professional association that keeps membership naturally diverse instead of self-selected around expected claims. It's easy to confuse this rule with other group insurance concepts. Employer cost savings is a legitimate benefit, not a harm. Certificates of coverage just prove membership. Coordination of benefits manages multiple payers. None of these is the danger this rule targets, only adverse selection is. Remember, the independent purpose requirement exists to stop adverse selection, not to save money or manage paperwork. Question 37. A whole life policy owner borrows against the policy's cash value, and any unpaid balance at death reduces the benefit. This feature is known as which of the following? Your options are a partial surrender, B. A dividend withdrawal, C. A policy loan, D. An accelerated benefit. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. A policy loan. C is correct because a policy loan lets the owner borrow against the cash value while the policy stays in force. Any outstanding balance plus interest is subtracted from the death benefit if it is not repaid. A is wrong because a partial surrender permanently withdraws part of the value and reduces coverage, rather than creating a loan that can be repaid. B is wrong because a dividend withdrawal takes accumulated dividends and is available only on participating policies, not a loan against cash value. D is wrong because an accelerated benefit advances part of the death benefit for terminal illness and is not a loan taken against the cash value. Let's look at how a policy loan works within permanent life insurance. A whole life policy builds cash value over time, and a policy loan lets the owner borrow against it while coverage stays in force. The insurer advances funds up to the available cash value. Interest accrues on the balance, and there's no fixed repayment schedule, but any unpaid balance plus interest reduces the death benefit paid to the beneficiary. Picture the cash value as collateral sitting inside the policy, with the loan balance and accrued interest drawn against it. If that balance remains unpaid at death, it's subtracted directly from the death benefit. This differs from a partial surrender, which permanently withdraws value and cuts coverage, a dividend withdrawal, which only applies to participating policies, and an accelerated benefit, which advances the death benefit for terminal illness. None of these are loans against cash value. Remember, a policy loan keeps the policy in force and merely reduces the death benefit by any unpaid balance, unlike a surrender that permanently cuts coverage and value. Question 38. When an employee leaves a job covered by group life insurance, New York generally lets that person convert to an individual policy without doing which of the following? Your options are A. Paying any premium, B. Choosing a beneficiary, C. Applying within any time limit, D. Proving insurability. Which would you go with? Lock it in before the reveal. The correct answer is D. Proving insurability. D is correct because the conversion privilege lets a departing employee move to an individual policy without showing evidence of insurability. The person must still apply within the allowed window and pay the individual premium. A is wrong because conversion does not make the new coverage free. The former employee pays the individual policy premium based on attained age. B is wrong because the converted policy still requires a beneficiary designation, so naming a beneficiary remains part of completing the new contract. C is wrong because a time limit does apply. The employee must exercise the conversion right within a set period after group coverage ends. Group life insurance offers a powerful protection called the conversion privilege, kicking in exactly when an employee is most vulnerable to losing coverage. When employment ends, group coverage ends too, and someone who's grown sick could become uninsurable overnight. The conversion privilege exists precisely to catch that person, letting them carry protection forward into an individual policy no matter their health. The mechanism is simple. Once group coverage ends, the employee has a limited window, often around a month, to convert. Within that window, the insurer must issue an individual policy without asking for evidence of insurability, though the premium reflects the person's attained age. Only one thing is waived: proof of insurability, meaning no medical exam or health questions. Everything else still applies: timely application, a premium based on attained age, and naming a beneficiary. So when a scenario shows someone converting from group to individual life insurance without doing something, the answer is proof of insurability, not the premium, not the deadline, not the beneficiary form. Question 39. Which of the following is a feature of whole life insurance that ordinary term insurance does not provide to the policy owner? Your options are A. A guaranteed cash value, B. A death benefit, C. A named beneficiary, D. A premium payment. Don't overthink it. Which one feels right? The correct answer is A. A guaranteed cash value. A is correct because a guaranteed cash value is the defining extra that whole life offers, and term does not. The value builds over time and supports loans, surrender, and the non-forfeiture options. B is wrong because a death benefit is common to both term and whole life, so it does not distinguish permanent coverage from temporary protection. C is wrong because a named beneficiary appears on every life policy, term or permanent, and therefore is not unique to whole life insurance. D is wrong because a premium payment is required for both kinds of coverage and is not a feature that sets whole life apart from term. The guaranteed cash value is the single feature that separates whole life from term insurance. Let's see why this savings element makes whole life permanent while term stays temporary. Term premiums pay only for the risk of death during a set period, leaving nothing behind. Whole life charges a level premium that, in the early years, exceeds the true cost of protection, and that excess builds into a guaranteed cash value. This guaranteed account grows on a set schedule as premiums are paid, reaching defined amounts at defined times. The policy owner can borrow against it, surrender the policy for it, or use it through non-forfeiture options if premiums stop. A death benefit, a named beneficiary, and a premium are common to both term and whole life, so none of them sets permanent coverage apart. Guaranteed cash value is the one feature unique to whole life. When a scenario asks what whole life offers that term does not, the answer is the guaranteed cash value, the accumulating savings element that only permanence provides. Question 40. Employer-provided disability coverage that replaces income for a brief span, often a few weeks to several months, before long-term coverage begins is best described as which of the following? Your options are A. Long-term disability insurance, B. Short-term disability insurance, C. Business overhead insurance, D. Presumptive disability insurance. Got a guess? Lock it in. The correct answer is B. Short-term disability insurance. B is correct because short-term disability insurance replaces income for a brief period, commonly several weeks to a few months. It bridges the gap until long-term disability coverage, if any, takes over. A is wrong because long-term disability insurance begins after short-term coverage ends and pays for years, not just the first weeks of a disability. C is wrong because business overhead insurance reimburses a business owner's office costs, not an employee's personal income during a short disability. D is wrong because presumptive disability describes an automatic finding of total disability for severe losses, not a short duration of income replacement. Short-term disability insurance exists to cover the immediate aftermath of a disabling event. The clearest way to understand it is through its timeline. Because disabilities range from a quick surgery recovery to a permanent condition, no single policy can price both well. Short-term disability has a short waiting period and short benefit duration, replacing a percentage of income, and then handing off to long-term coverage if the employer offers it. Picture a bridge, disability onset on one side, a brief elimination period, then short-term disability benefits carrying the worker across the early weeks and months, and finally connecting to long-term disability coverage on the other side if the disability continues. It helps to distinguish short-term disability from its neighbors. Long-term disability picks up after short-term ends and pays for years. Business overhead insurance covers a business owner's office expenses rather than personal income. And presumptive disability is an automatic finding for severe losses, not a duration of income replacement. Remember the pattern. A brief period of income replacement that precedes long-term coverage signals short-term disability insurance, defined by its short duration and its role as the bridge. Question 41. Because New York prohibits medical underwriting of Medicare supplement applicants, an insurer generally may not do which of the following? Your options are A. Charge an approved community-rated premium, B. Offer a standardized lettered plan, C. Reject an applicant due to poor health, D. Require enrollment in Part B. Which one is it? Pause the video if you need more time. The correct answer is C. Reject an applicant due to poor health? C is correct because with medical underwriting barred, a New York insurer may not reject a Medicare supplement applicant because of poor health, which is how the state guarantees access to this coverage for seniors. A is wrong because charging an approved community-rated premium is permitted. Community rating is in fact how New York prices these policies fairly. B is wrong because offering a standardized lettered plan is allowed and expected, since those standardized plans are the products sold in the market. D is wrong because requiring Part B enrollment reflects how supplements pair with Medicare and is not the health-based rejection the rule prohibits. New York guarantees that older residents can't be denied a Medicare supplement because of their health history. To understand why this matters, we first need to see what insurers normally do. In most insurance lines, underwriters study an applicant's health and choose to accept them, charge more, or decline coverage entirely. New York strips that power away from Medicare supplement policies, leaving insurers no basis to say no. A guaranteed issue policy works like this. No health screen blocks entry. Everyone pays the same community rate. And the only requirement is enrollment in Medicare Part B. Carriers can still charge the approved community rate, offer the standardized lettered plans, and require Part B enrollment. Those are all lawful. The one move forbidden is rejecting someone for poor health. This is the carved-out exception to how insurance usually works. A senior's diagnosis can never be the reason coverage is refused. Question 42. Most long-term care policies begin paying benefits when the insured can no longer perform a stated number of routine personal activities. These activities are commonly called which of the following? Your options are A. Instrumental tasks, B. Essential health benefits, C. Presumptive activities, D. Activities of daily living. Take a second. Which answer would you pick? The correct answer is D. Activities of daily living. D is correct because activities of daily living, such as bathing, dressing, eating, and transferring, serve as the benefit trigger. A policy typically pays once the insured cannot perform a set number of them. A is wrong because instrumental tasks like managing money or shopping are a separate category and are not the standard long-term care benefit trigger. B is wrong because essential health benefits are the core services an Affordable Care Act plan must cover, unrelated to triggering long-term care benefits. C is wrong because presumptive activities is not a recognized term. The standard trigger is the inability to perform activities of daily living. Long-term care policies don't pay based on diagnosis, some or not. They pay based on a precise, measurable trigger called activities of daily living. The standard checklist includes 6 basic functions: bathing, dressing, eating, toileting, transferring, and maintaining continence. Most policies set the threshold at losing just 2 of these 6. A licensed assessment observes whether a person can still perform these basic self-care acts, not whether they feel sick. Once an evaluator confirms 2 of the 6 are lost, the benefit trigger fires. There are actually 2 recognized doorways into benefits: the physical function test and a severe cognitive impairment test like advanced dementia, where supervision itself becomes the need. Watch out for instrumental tasks like managing money or groceries, which sound similar but never serve as the actual trigger. Whether it's a stroke survivor or an aging widower losing the ability to bathe or rise unaided, it's documented loss of basic self-care, not age or illness, that opens the door to coverage. Question 43. An insurer that has received a certificate of authority from the superintendent to transact insurance in New York is best described as which of the following? Your options are A. An authorized insurer, B. An excess line insurer, C. An unauthorized insurer, D. A surplus insurer. Before I reveal it, which one do you think is right? The correct answer is A. An authorized insurer. A is correct because an insurer holding a certificate of authority is an authorized or admitted insurer. That certificate is the state's permission to transact the lines of insurance named in it. B is wrong because an excess line insurer accepts risks, The admitted market declines and operates without a New York certificate of authority for ordinary business. C is wrong because an unauthorized insurer is exactly the opposite, a company that lacks the certificate of authority and may not freely solicit New Yorkers. D is wrong because surplus is not a licensing category. It describes an insurer's financial cushion above its liabilities rather than its authority to operate. Every insurer in New York falls on one side of a bright line, invited in by the state or not. That invitation takes a very specific form. The superintendent issues a certificate of authority naming the specific lines a company may transact. That single document is what makes an insurer authorized, also called admitted, and it signals the company files its rates, meets capital rules, and backs the guarantee fund. An authorized insurer holds the certificate and may freely solicit New Yorkers. An unauthorized insurer holds no certificate and cannot transact ordinary business here. An excess line, or surplus lines, carrier rights only risks the admitted market has declined, and only through a specially licensed broker. Surplus describes an insurer's financial cushion, assets minus liabilities, so it speaks to solvency, not authority. A company can be flush with surplus and still be unauthorized in New York, because holding money is a separate matter from holding the certificate. Whenever a scenario mentions the superintendent's certificate to transact specified lines, that company is an authorized or admitted insurer. The certificate itself, not surplus and not the size of the company, is what separates the welcome carrier from the one still outside the gate. Question 44. An applicant pays the first premium with the application and receives a receipt that can make coverage effective before the policy is delivered, provided the insured proves insurable. Which receipt is this? Your options are A. A binding receipt, B. A conditional receipt, C. An inspection receipt, D. A delivery receipt. What's your answer? Commit to one before I continue. The correct answer is B. A conditional receipt. B is correct because a conditional receipt can make coverage effective as of the application or exam date, but only if the applicant turns out to be insurable under the insurer's standards. A is wrong because a binding receipt grants immediate temporary coverage with no insurability condition, which is common in property lines but not the conditioned life receipt described. C is wrong because an inspection receipt acknowledges the applicant received the policy for a review before paying and creates no coverage at all. D is wrong because a delivery receipt merely documents that the policy was handed over and does not by itself make coverage effective earlier. When you pay your first premium along with a life insurance application, a small document called a conditional receipt can start your coverage early. The conditional receipt exists to fill the gap while underwriting takes time. If the applicant proves insurable, coverage relates back to the application or exam date. If not, no coverage ever existed and the premium is returned. Picture the conditional receipt as a bridge across the underwriting gap, connecting the day you pay to the day your policy is delivered, active only if you prove insurable. Contrast this with three lookalikes. A binding receipt grants immediate coverage with no insurability test at all. An inspection receipt lets you review the policy but offers no protection. A delivery receipt merely documents that the finished policy was handed over. The signal words are simple: premium paid with the application, coverage before delivery, and contingent on proving insurable. That combination always points to the conditional receipt. Question 45. The amount of covered medical expense an insured must pay out of pocket each year before the plan begins paying its share is known as which of the following? Your options are A. The co-payment, B. The coinsurance, C. The deductible, D. The premium. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C, the deductible. C is correct because the deductible is the set amount the insured pays each year before the plan starts sharing covered costs. A higher deductible generally lowers the premium because the insured absorbs more initial expense. A is wrong because a co-payment is a small fixed charge at each visit or prescription and is not the annual threshold met before coverage begins. B is wrong because coinsurance is the percentage of costs shared after the deductible is met, not the initial amount paid before the plan pays. D is wrong because the premium is the price paid for the coverage itself and is unrelated to the out-of-pocket threshold preceding benefits. Every health plan asks the insured to climb through layers of cost sharing, and the first layer to climb each year is the deductible. The deductible is the fixed dollar amount of covered expenses paid entirely by the insured before the plan contributes anything. It resets every plan year, and choosing a higher deductible always lowers the monthly premium, since the insured is absorbing more of the initial risk. Think of it as a gate. Covered expenses fill up like water behind a dam until they reach the deductible threshold, say $1,000. Once that threshold is crossed, the plan begins paying its share for the rest of the year, and the tally resets to zero when the new plan year starts. It's easy to blur the deductible with its cost-sharing cousins. The deductible is the annual threshold met before benefits start. The co-payment is a small fixed fee paid at each visit, and coinsurance is the percentage split, like 20/80, that applies only after the deductible is satisfied. Remember the signal words: an amount paid out of pocket each year before the plan pays, palm-armed. That's the deductible, the very first gate in the cost-sharing climb. Question 46. A client wants prescription drug coverage to go with original Medicare. A modern Medicare supplement will not provide it. So the client should instead enroll in which of the following? Your options are A Medicare supplement plan, B, Healthy New York, C, workers' compensation, D, a Medicare Part D plan. Which would you go with? Lock it in before the reveal. The correct answer is D, a Medicare Part D plan. D is correct because modern Medigap policies exclude drug coverage. A client who wants prescriptions covered alongside original Medicare should enroll in a separate Medicare Part D prescription drug plan. A is wrong because another Medicare supplement still would not add drug coverage, since modern Medigap policies do not include a prescription benefit. B is wrong because Healthy New York is a small employer affordability program and is not the route to prescription coverage under Medicare. C is wrong because workers' compensation covers job-related injuries and has nothing to do with adding drug coverage to a person's Medicare. Modern Medicare supplement policies contain a deliberate gap: no drug coverage. Understanding that gap points directly to where prescription protection actually lives. A beneficiary assembles coverage from three separate pieces. First, original Medicare for hospital and medical care. Second, a Medigap supplement for the coinsurance and deductibles Medicare leaves behind. And third, a Part D plan for prescription drugs. It's tempting to solve a drug gap by stacking another Medigap policy, but no modern supplement includes that benefit. Programs like Healthy New York and workers' compensation address entirely different needs and offer no drug coverage either. The only real fix is a standalone Part D plan. Picture a retiree in Albany with original Medicare and a supplement who needs an expensive new medication. The supplement pays nothing toward it. Enrolling separately in a Part D plan is what finally closes that gap. Remember, drug coverage alongside original Medicare lives in Part D and nowhere else among these choices. Question 47. The process by which a health plan reviews proposed or ongoing care to confirm it is medically necessary and appropriate is best described as which of the following? Your options are A. Utilization review, B. Coordination of benefits, C. Underwriting, D. Capitation. Don't overthink it. Which one feels right? The correct answer is A. Utilization review. A is correct because utilization review evaluates whether care is medically necessary and appropriate before, during, or after it is delivered. It is a cost containment tool managed care plans use to avoid unnecessary services. B is wrong because coordination of benefits decides payment order between two plans covering the same person, not whether a service is medically necessary. C is wrong because underwriting evaluates an applicant's risk before issuing coverage and does not review the necessity of care during a claim. D is wrong because capitation is a payment method giving providers a set amount per member and is not a review of medical necessity. Managed care plans control costs by checking whether proposed or delivered care is actually warranted. That checking process is called utilization review, a deliberate checkpoint that keeps spending focused on care patients truly need. Utilization review is the systematic evaluation of whether a service is medically necessary and appropriate. It exists because unchecked procedures, extra hospital days, and duplicate testing can inflate claims. So a reviewer checks the care itself. Utilization review takes three forms depending on timing. Prospective review, or pre-authorization, decides if planned care should proceed. Concurrent review monitors an ongoing hospital stay, and retrospective review checks a completed claim. All three test the same thing, medical necessity. Picture a plan in New York City asking a reviewer to approve a proposed back surgery before it's scheduled. That necessity check, testing whether the care fits accepted standards, is utilization review in action. Three lookalikes get confused with utilization review. Coordination of benefits just decides which plan pays first. Underwriting screens applicants before coverage even begins. And capitation pays providers a flat monthly fee per member. Only utilization review asks whether the care itself was necessary. Question 48. An applicant who presents the average level of risk the insurer expects, qualifying for normal premium rates, is placed in which underwriting classification? Your options are A. Preferred, B. Standard, C. Substandard, D. Declined. Got a guess? Lock it in. The correct answer is B. Standard. B is correct because A standard classification fits applicants who match the insurer's expected average risk. They receive ordinary rates, neither discounted for excellent health nor increased for added risk. A is wrong because A preferred classification is reserved for applicants whose superior health and habits justify rates lower than standard, exceeding average expectations. C is wrong because A substandard classification applies to higher than average risks, who pay extra, the opposite of an applicant presenting the expected average. D is wrong because A declined applicant is one the insurer will not cover at all, which is far beyond simply being an average. Insurable risk. Underwriters sort every applicant into a risk tier, and the classification sitting exactly in the middle is called standard. A standard risk is simply average. Health, habits, and circumstances all matching what the insurer expected when it priced the product. That person pays ordinary premium rates, with no discount for being unusually healthy and no surcharge for extra risk. Picture every applicant placed along one continuous risk scale. Preferred sits below average risk. Standard anchors the exact center, and substandard sits above it, each position pricing risk fairly so the whole pool stays stable. Lookalike classifications each pull toward an extreme. Preferred rewards better than average health. Substandard charges more for added risk. And declined refuses coverage entirely. Standard is the only tier with no reason to discount or surcharge. Whenever a scenario shows an applicant matching the expected average risk and earning normal premium rates, the answer is standard. Nothing to reward and nothing to penalize. Question 49. When a policy owner stops paying premiums on a whole life policy and chooses to take the accumulated cash in hand, they are using which non-forfeiture option? Your options are A. Extended term insurance, B. Reduced paid-up insurance, C. Cash surrender value, D. Automatic premium loan. Which one is it? Pause the video if you need more time. The correct answer is C. Cash surrender value. C is correct because choosing the cash surrender value ends the policy in exchange for its accumulated cash. The owner receives the money directly and the coverage terminates once the surrender is complete. A is wrong because extended term keeps the full benefit in force as term insurance and does not hand the owner the cash value to keep. B is wrong because reduced paid up uses the cash value to buy smaller permanent coverage rather than paying the value out to the owner. D is wrong because an automatic premium loan borrows against the value to pay a missed premium, which keeps the policy rather than cashing it out. When a whole life policy owner stops paying premiums, the cash value doesn't disappear. Non-forfeiture rights guarantee the owner receives that money in one of several forms. This protection exists because the cash value truly belongs to the policy owner. Whole life premiums are level and front-loaded, building a savings element inside the policy, and the insurer cannot simply keep that accumulation. The owner has options to reclaim it. Choosing cash surrender is simple. The owner notifies the insurer, the policy terminates, and the insurer pays out the accumulated cash value minus any outstanding loans. Once paid, coverage ends completely. There's no lingering death benefit. Contrast this with the lookalikes. Extended term insurance uses the cash value to buy term coverage at the same face amount. Reduced paid-up insurance buys a smaller permanent policy needing no more premiums. And an automatic premium loan borrows against the cash value just to keep the policy from lapsing. None of these hand cash directly to the owner. Only cash surrender value pays the accumulated cash directly to the owner while ending the policy for good. That's the detail worth remembering. Question 50. An annuity bought with after-tax dollars outside any employer retirement plan, so that only its growth is taxed at payout, is best described as which of the following? Your options are A qualified annuity, B. A pension annuity, C. A tax-sheltered annuity, D. A non-qualified annuity. Take a second. Which answer would you pick? The correct answer is D. A non-qualified annuity. D is correct because a non-qualified annuity is funded with after-tax dollars outside a qualified plan. Because the contributions were already taxed, only the earnings portion is taxed when income is paid out. A is wrong because a qualified annuity is funded with pre-tax dollars inside a retirement plan, so its full distribution, not just the growth, is taxable. B is wrong because a pension annuity is part of an employer plan funded on a tax-favored basis and does not describe an individually owned after-tax contract. C is wrong because a tax-sheltered annuity is a qualified arrangement for certain employees using pre-tax dollars, again unlike an after-tax non-qualified contract. Annuities live in two tax worlds, split by whether the money used to buy them was already taxed or never taxed at all. A non-qualified annuity is purchased with after-tax dollars outside any employer retirement plan because that money was already taxed once. Only the growth is taxed when it's paid out, and the principal comes back tax-free. Qualified annuities are funded with pre-tax dollars inside an employer plan, so the entire distribution is taxed. Non-qualified annuities use after-tax funding outside a plan, so only the growth is taxed. At distribution, the contract layers two amounts together, the original after-tax contributions, called basis, return free of tax, while the earnings are taxed as income. The split protects money that already faced taxation once. The signal words are after-tax dollars outside an employer plan and only growth taxed. Trace those and you'll always spot a non-qualified annuity. That brings today's New York Life, Accident and Health Review to a close. If you're hungry for more practice, our website has you covered with hundreds of free questions and complete study guides, all ready for you to explore. There's plenty to work through, no matter where you're starting from. Just click the link down in the description below and you'll be on your way to keep sharpening your skills in no time at all. Subscribe and stay tuned for the next part. Good luck on your exam.